Participating in the markets is not about being right or wrong, nor is it about defeat. It's about making decisions. Welcome to Lessons I. So as per normal, we're now back for lesson 14. This is the third of our strategies. So we said we're going to do 5 strategies. We're going to go through the templates, keep updating them, lots of examples, lots of learning opportunities for you. So we're going to follow almost the exact same structure that we've done in the previous 2 strategy sessions. Of importance, and again, I'll keep reiterating this, but if you don't follow such a stringent process, and you don't create this process for yourself, the consequences is that in the long run, you're going to have a lack of a strong process to facilitate pattern recognition. And that's why, we're doing so many examples. That's why I'm getting you to utilize this template time and time again. And that's why, as you'll see when I get to the next slide, why I'm also mixing up the learning process for you as we go through each one of these strategies. Remember, the objective here is I want to unlock your understanding of the progression truths that we've dealt with. And that's hopefully where you're starting to realize now. You're starting to get to that point when you can see the power of what we're trying to do here with these 5 strategy sessions. Okay, so straight into it. Now, a little bit of a twist as we go into the next 2 trade strategies. What I'm trying to do is I just want to mix up the learning process a bit. What I did in the first of the strategies was I took you through it step for step as to how I would recognize the pattern, the characteristics that I observe, the way I execute, my entry point, my notes, the way I see things. So I did all of that in the first 2 strategies. In this third strategy, I'm going to mix it up a little bit now. So we're going to go as per normal. I'm going to narrate the strategy for you. I'm going to explain structural breakouts to you. I'm going to explain everything to you as you need to understand it. Then we're going to go through a number of different examples of structural breakouts. Okay, I'm also going to take you through a few charts to view specific examples of a textbook example, a nuance example, and a failure example. What you're going to do then is you're going to go away and complete the template on your own. In other words, I'm not going to give you any hints as to execution. I'm not going to give you any hints as to what the pattern is to recognize. I want you to recognize it yourself. Okay, so this is going to be a little bit less hand-holding from me in the initial part of this lesson. But not to worry, at the end of the lesson, when we get to the prescribed drills and video review, I will then share with you my template. Okay, and again, I'm doing it this way around because I want you to get into the habit of building this template with your own understanding and observation. So that's part 1. Part 2, okay, we're going to go through the template review. So I'll take you through the expectations, characteristics, and statistics. So I'll show you some of the key things that I observe with regards to structural breakouts. We're then going to go through examples 4, 5, 6, 7. Again, you're going to update the template in terms of the entry, exit, access methodologies, and the notes. And then as per normal, 3 live examples to really make sure that you're getting the timing right. You're aware of what a structural breakout is. You're aware of what the access methodologies are that can potentially show up. Okay, and then lastly, the prescribed drills and the video review section. So that's where we're going to go with this lesson. Let's get straight into it. Now, you will all know what structural breakouts are. Quite possibly, this is one of the best, I would say, strategies for new traders to learn to adopt. And there's a very simple reason for that. Okay, a structural breakout is a very straightforward strategy in that, number 1, the strategy is we have to define something called structure. And then number 2, we just have to find a consistent methodology for executing that thing we call a structure. Now, before I get going in this, I just want to tell you, you very often watch videos of some of the Axia traders on YouTube. And a lot of those trades, you'll see traders making 50 grand and 100 grand and sometimes even £500,000. Now, 2 of the top traders at Axia are actually both structural breakout traders. One trades structural breakouts with regards to ledgers, okay, and we're going to talk about that type of structural breakout. And the other one trades more flow type structural breakouts. In other words, looks at things like consolidation structures in particular. And that trader is also, well, both of those traders are both seven-figure traders. So the important thing to take away is not that structural breakouts are necessarily the best strategy. They are just one of many strategies. But the real lesson I want you to adopt here is to really get an understanding of the structured approach in defining what structure means. Now, you'll understand this as I go through the next couple of slides, but in essence, it's not just about putting a line on your chart, calling it resistance, and then simply, buying through that resistance and expect to become a seven-figure trader. That's not what it's about. It's about having a rules-based approach to define what constitutes support and resistance so that you can have consistency in your methodology. And the second part is then working on the variations of that structure called support and resistance, but most importantly, finding a methodology to execute that tradable structure called support and resistance. Okay, and that's where this is all going to marry up quite nicely, because most of you will know these structures, most of you will recognize these patterns. Most of you probably haven't heard of the Access methodology yet, so I'm giving you now an understanding of the structure, and hopefully you can take it and create your own rules-based approach to defining the structures, but then marrying it with this new methodology called Access methodology, and following the rules-based approach that if we have a structure and we have an access, then suddenly we have a very powerful, high probability trade opportunity. Remember what we said. A trade strategy or a trade structure, as I'm going to show you, without access, you've just got a good idea. And I will forewarn you, one of the biggest mistakes traders make with regards to this strategy is because they understand the structure, because they recognize the structure, they get very excited about it. Now we know what happens when we get excited. There's a tendency to preempt. Okay? And that is why Access methodology is particularly important for this kind of strategy. It allows you to be patient. It allows you to, more importantly, recognize when that mass participation is coming to the market in order to break out of those structures. So, here are the structures we're going to deal with. Support and resistance. Trend line structures. Ledgers, also known as weak positioning. Price discovery high-low. Key auction reversals. And consolidation structures. Okay, now they're breakouts. So, they are breakouts out of all 6 of these types of structures. Now, what you will notice is we will use a daily or 120-minute time frame to determine various structures. Now, for this course, I'm only going to show you structures in the daily, but like I've said before, you can utilize this on any longer time frame charts. It might be monthly, it could be yearly, it might be 240-minute, 120-minute, or even 60-minute. Generally speaking, because structures are bigger time frame, technical analysis, I always urge users to avoid going too narrow or too small a time frame. Okay, so I wouldn't typically apply this myself on anything less than 120 minutes. So just be aware of that. Now, it's not to say that you cannot apply it. Of course you can, but you must go and follow the same methodology. Develop the rules. Make sure you get access to that rules-based structure and execute only when you have access and a structure together. Okay, so what are we talking about here? Now, in essence, if I'm going to draw a picture, you all know what a breakout is. Now, it's important to make sure that you're aware of what we mean when we say a breakout. And the best way to explain it is, we're going to go with our first example. We all know what a resistance line is. Now, the most important thing for something to be deemed a structural breakout is that we need to see volatility and volume on the break of a trigger point. In other words, if we deem this to be resistance, i.e. the point where buyers no longer want to commit above, the moment we get above that point, by definition, we should see commitment. Okay? Commitment means high volume. Commitment also means a lot more participants suddenly coming and rushing in together at the same time. Therefore, volatility. Okay, and those are the two identifiers that we will utilize for breakouts. We always want to see volume and volatility, i.e. a change in the interaction of the market, a lot more participation coming into the market. If we have those two over a trigger price, in this instance called resistance, we then have the potential for a breakout. In other words, the market wants to find a different area of value. Okay, and that's all breakout trading is. It's flows coming into the market because there's been a break, and therefore now there is commitment. Now, it's not to say that every breakout results in easy opportunities or a price discovery mode. It doesn't work that way. Some breakouts are very, very clean and give very good opportunities. Other breakouts are less so. Again, this is what it comes down to. We need to learn to differentiate between the textbooks, between the nuances, and between the failures. And that will only come with repetition. So, our first of these structures, it goes without saying, we've dealt with this. Now, it's very important that if you're going to take this trade strategy, you must develop your own rules-based approach to defining it. You cannot just draw a line and call something support and resistance. And we spoke quite extensively about this in lesson 7, which is, these are the rules you follow in order to call something support and resistance. Without them, all you have is just a pretty line on a chart. We also said that it's very, very important that you're only putting these lines and these structural cues on your charts once you've done the homework. Okay, you don't simply put a line because it might be support or resistance. You put a line because you've done the homework and you've recognized that, yes, this is resistance. And if there is resistance plus the potential access opportunity, you've got a tradable opportunity. Okay, so why do we have, what's the purpose of support and resistance? Well, it defines where there's a lack of commitment. Okay, it goes without saying. Also, we know confirmation closes are showing us that commitment. And this is quite important because we will need to recognize that within our access methodology. We said in access methodology that we are aggressive should the access occur after the trigger point. Sorry, we're passive should the access occur after the trigger point. And we're passive, okay, I'm getting this completely mixed up. So I'm going to use an annotation. If this is our resistance line and we have access through that trigger point, we can be passive in our entry. In other words, we don't have to buy the high price. We can allow the market to come back and give us an entry point with a limit order in the market. If, however, the access occurs before the resistance, we can afford to be aggressive on entry. Why? Because we know that the trigger point is higher up. Therefore, we're getting really good reward by being aggressive and by preempting that break point. Okay, hopefully that clears that up. Now, the rules. We've spoken about these. I'll reiterate them. 3 or more times, price is incapable of closing beyond a specified price zone. The moment a market is incapable of closing beyond a certain price zone, okay, remember it's a price zone, not an exact price. At that point, we can deem it support or resistance. And there must be confirmation with trigger price action. In other words, really good support and resistance, you will know about it once it breaks beyond that point because the market will tell you that there's a mass agreement with volume and volatility once we get beyond that point. Okay. So that is support and resistance. Now, these are my rules. It's not to say these are the best rules or these are the only rules, but they are consistent rules that I apply to calling something support and resistance. If neither of those two things are there, I don't call it support or resistance. So the most important thing is you must define your rules-based approach in defining this type of structure. Then the next type, okay, is trend line structures. Again, we've been through this, but I will reiterate. Right? We all know what a trend line is. So there's 2 reasons we identify trend lines. One is so we can identify a series of higher lows and higher highs. In other words, a range trend. We want to see when the market is in a range, but ultimately trending higher. We also want to be able to connect buying and selling initiative positioning trigger points. In other words, if a market's very aggressively pinging off of certain areas where there's very aggressive buyers entering the market, we want to make sure we're drawing a trend line so that we can connect where that positioning has taken place. Why? Because once we get below that positioning, we've got a potential breakout opportunity. Now the rules. We only connect higher lows and higher highs on closed bars. In other words, it must be closed bars, and we need a minimum of 3 of them. Okay, and we spoke about that being that's a lower high, that's a lower high, sorry, that's a higher low. Let me get a different color here. Okay, so that's a higher low, that's a higher low, that's a higher low, that's a higher high, and higher high. Only once we've got 1, 2, and 3 can we deem it a trend line structure. Okay, so that's all we're saying. And then the second part is we need to see initiative. In other words, if we want this second type of a trend line, we've got to see very aggressive buying off of this trend line. Right? Then we can deem this an initiative trend line. Okay, so those are the first two types of structures. Excuse me. Now, the third type is ledgers. Okay, you would have heard some traders maybe referencing this on Twitter, but a ledger is nothing more than a very unique price point. Now, this is less of a price zone and more of a price point where the market keeps coming to this price point and then it just sits there and nothing happens, and then it slowly backs off, and then it does the same thing, and then slowly backs off, and then does the same thing, and it kind of forms a ledge in the market. And a ledge is just this inability of being able to get beyond that price point. Now, ledges are slightly different to resistance in a sense that ledges are not necessarily sellers that are wanting to engage in the market and take it back down. No. Ledges tend to be formed by just a complete lack of trade, really. In other words, there's no real big time frame participants trading. The market gets up there. There's equally no one willing to take it through that price point. Right? So the slight differentiation between support and resistance is that support and resistance tends to happen over a longer period of time, whereas ledges tend to occur over different degrees of time. So we can get ledges on 1 minute charts, 5 minute charts, 15 minute charts, and sometimes, as you'll see, on daily charts. The point being is that the price action where these ledges are formed is different to support and resistance in a sense that it's the inability of anyone really to transact at those levels. Okay, so that's what a ledge ultimately is. Now, in terms of the structure, at some point a ledge breaks, and that's the reality. The moment we can identify something as a ledge, we know that at some point in the future this structure will resolve itself. Okay, with 100-degree certainty or 100% certainty, it will resolve itself. And it's that resolution, it's that break beyond that we're interested in. Okay, tends to be a bit of a stop run, and we want to partake in that stop run. Now, the rules, we need 3 or more of these. Okay, and I'll show you a few of these examples in a minute, so don't worry too much if you've not heard of this type of structure. Okay, now, our next structure is price discovery high and low. You might have heard this word. Again, price discovery is nothing more than the market entering a new realm of trend. Okay, in other words, it's when, and the best place to explain this is, it's when we get to something like record prices. Right? We see the US equities right now, they're all at record highs. In other words, they're in price discovery mode. They're trying to discover where there may be some form of liquidity being provided. Okay. Now, there's different rules to call something price discovery. Either it's record prices. Pretty straightforward. We can all observe when a market's at record prices. Or a market is in uncharted area. In other words, it's not been in this price zone for a number of months and years. Okay. In other words, it's the market that's now broken into uncharted territory. It's obviously traded those prices at some point in the past, but it's not been there for a very significant period of time. We call that price discovery. And then new fundamental drivers. In other words, sometimes the markets move into these new price zones because of a fundamental driver. And a good example to use is when oil broke this year below $40, it obviously went to zero and eventually went to minus $40 or whatever it might be. Okay, so again, in that sense, the market enters price discovery mode. Now, why I like this example of oil, for example, is not that I thought oil could go negative. Of course, I didn't think that. But it points out the most important part of price discovery, which is it's a momentum flow type strategy. Okay, in other words, it's bringing big time frame participants in the market, big funds, institutions, and therefore we do not want to go against it. right? Not because the market can't fail, but because it requires a significant amount of liquidity to be provided in order to turn the market around. And we saw that in the oil, once it started to break down, everyone, or there was a large, significant a number of buyers in the market that had outstanding long positions, and they needed to get out of them. And the only way you can get out of a long position before expiry is to sell. Now, if you're selling and no one is providing liquidity to buy, the market will go as low as it needs to find those buyers. And that's why price discovery is something, or a structure, that we have to be aware of. Now, the next structure then is key auction reversals. And the best way to explain this is with a pattern called a V. Okay, and obviously it can be the opposite as well. Now, an auction reversal is nothing more than when we have initiative to the downside. Okay, so very aggressive sell-side price action, which includes high volume, high delta interaction, and we get the equal and opposite. All right, so it's an equal and opposite type formation, but in essence, what it's telling us is that yes, there were very aggressive sellers all the way down, but equally there were very aggressive buyers all the way up. Now, this type of price action tends to be very bullish. All right, now in other words, when we see this kind of price action, it means that there are significantly strong buyers in the market at this point. And what we're going to see when we go through a few opportunities is that we are looking to play for breakouts below these significant buy points in the market when they occur. We don't preempt them. We don't assume they will break, because very often these big time frame V reversals take months and years to come back and break out. But we're aware of them. We're aware of the potential if we get to those price points at some point in the future. Right? And it goes without saying that it can be, in this instance, a buy side V reversal, and in this instance, a sell side V reversal. Now, the purpose of this structure, it unlocks an area of influential participants. In other words, it shows us where the big participants are. Okay, now if we know there's big participation there, it means there's big positioning, and that creates the opportunity for breakouts. Now the rules, we need symmetry. Okay, we need symmetry in and out. Now the best way to also think of this symmetry is when we get one time framing in and we get one time framing out. Okay, now it's not always precise in terms of one time framing, but you get the gist of it. It's high volume sell side one time framing on the way down, and then equally high volume volatile buying on the way back up. Okay, we call that V or key auction reversals. And obviously note the high volume initiative. And then our last of our structures is what we call consolidation. And we spoke briefly about this when we spoke about this as an access type. So now note, we're going to use consolidation as a structural type, but also as an access type. And what you'll see actually when you start to go through a number of examples in the markets, very often some of the best breakouts of consolidation structures are actually consolidation access methodology. All right, it's something that looks like this, where we have a lot of consolidation, and in essence, just before the breakout, we get a lot of sideways consolidation. In other words, we get an access consolidation just before we break out of a consolidation area. Now, where you typically see this a lot is something called a flag. Now, most of you know a flag or a pennant or whatever you want to call it, but the point being is that a consolidation structure, the purpose of it is we call it the elastic band energy opportunity. In other words, when a market enters consolidation and moves sideways, it's building energy, building energy, building energy. Why? Because it's locking in positions on both sides. We have buyers that are buying and we have sellers that are selling. At some point, one of these two teams are going to be wrong. And it's that energy, it's that wrong team that's ultimately going to create that energy. Either the market goes up and the sellers are wrong and the buyers triumph, or it goes down. Or sometimes the buyers seemingly triumph, we have a false break, and we have a reversal. The point being is that the structure brings energy, and the energy brings opportunity. Okay, so that is then our last of our structures. Now, to define consolidation, it's important. We need 10 or more candles within a structure. And again, it doesn't matter what the time frame is, but we need 10 or more, because that tells us that there is a sufficient amount of two-way trade to bring in and start to create that energy desirable to get that potential opportunity. Now, key, and I've mentioned this already in the course, consolidation is very different to absorption. And this is something, if you've done the footprint course, you will know very much about. Consolidation is a low volume structure. In other words, the volume that's being transacted in this little sideways structure is relatively low. Okay, and that's important. That's the differentiation between consolidation and absorption. Absorption tends to be high volume, whereas consolidation, low volume. All right, so those are our 7 structures. Now, it goes without saying, you're going to be tempted to preempt. Why? Because one of the things you'll find is when you recognize a structure, straight away in your head you're going, oh wow, I've got this ledge in the market and I know it's going to break. With great degree of certainty, it's going to break. And I'll tell you a fact that to this day, one of the hardest structures to trade are ledges, because you start to build this bias almost on a day where you come in and you're like, today it's going to break. I'm 99% sure it's going to break. Now, can you see that bias narrative coming into your head? And we spoke a lot about this in the earlier part of the course, but can you see how suddenly I'm biased, where, there's a great degree of certainty that it's going to break. And more often than not, it does break. That's the reality. The problem is that just because you're 99% certain doesn't mean that you can break the rule of going in without access. Remember, the access protects you. And that's why we follow the access methodology, because it protects you from preempting. But it goes without saying that there are times where you have to preempt. And we've also spoken about this already, but just to reiterate, remember, you can preempt when the risk-reward symmetry no longer makes sense. So, we ideally want trades where we are taking 1R risk and getting whatever, 2 or more, whatever it might be. There's no special formula. The point is, we ideally want trades that have got more skew. Okay, so more asymmetrical. The moment we start to get more symmetrical in terms of the risk reward, that's when we have to start determining whether or not we should be preemptive. Okay, don't forget, more information, less reward, and the more risk you're taking. Okay, so the 2 examples where we will preempt are where we have stop runs, okay, where there's a liquidation of positions, and we spoke about why that is, right? It's the very nature that if we do not get in before that stop run occurs, the reality is we're going to be late to the party, and we're going to start looking to take a very small winner like that and have all this risk exposure, right? And the same with consolidation breakouts. Because they tend to have that energy involved, we want to almost be a little bit preemptive in those breakouts. Okay. Now, a little bit of admin again, just to reiterate. These are the color lines, and they'll be more relevant, they'll be more important now, so do make a note of them, because what we're going to do in the next couple of slides is we're going to go through our 5 markets. Now, what you might have noticed with these 5 strategies we're dealing with, we're going through the 5 markets: Bitcoin, oil, gold, euro, and the S&P 500. Now, it's important to note that I've taken 2 examples from each of the markets, and I did that simply because these are the 5 most tradable markets. They are very liquid, and it's important that you can see these examples playing out in all of the different markets. Now, if you look at my charts over the next couple of slides, these are the colors that you need to be aware of. Okay, the key auction reversals will be in the dark blue, the ledges will be in the green, the key support and resistance and the structural trend lines based on our rules will be red, the weekly support and resistance will be purple, and the daily high-low will be a brown. Okay, and we spoke about that in an earlier part. So be aware of those colors, because what we're going to do now is I'm going to give you the daily charts. Okay, I'm going to go through the first 2 of the daily charts, and I'm going to show you these 5 different, or these 6 different structures we've dealt with. I'm going to show you what they look like so that you can start to familiarize yourself with the different structures. Now, caveat, because I like caveats. These are a lot of structures. Okay, I've developed an understanding of these structures, not in the past month. Okay, I've developed them over the last 10 years. And that's how I'm capable of defining such specific rules, and more importantly, being capable of putting these lines on my chart. You have to start somewhere. That's the reality. Okay, but start by defining your own rules. Start by following that same rule day in, day out for a couple of weeks, couple of months. That way, you're going to develop your own understanding as to, 1, what defines these structures, but then also, you don't have to trade every one of these structures. You can trade one of them. Okay, you can become a master of support and resistance. And I cannot drive home and I cannot stress this point enough. One of Axia's biggest traders, and I'll repeat this, okay? One of the Axia's biggest traders makes 90% of his income trading effectively one of these 6 structural breakouts. One of them. Okay, it's also known as liquidation stops, or effectively where stop runs occur. Now you've heard of this. If you've been following the Axia guys for a while, you've heard of this, no doubt. And the reason I cannot begin to stress this enough is that too often as traders, we get lured into thinking that we need more strategies, we need more ideas, we need more in order to be more successful. That couldn't be further from the truth. It's the simplicity. It's the capability of taking one of these structures and being precise, having that discipline to be precise, having that patience to wait for that opportunity, even if it takes a month or two, and even if it comes at 2-3 a.m. in the morning. Okay, this trader that I'm specifically talking about that's so successful that with this one structural breakout would sit up for 6, 7, 8 hours and sometimes not even get the trade. The reality is he had the discipline, he had the patience, he had the consistency, he had all of these things you need, and when the time came, he did his job. He simply just executed the plan. And that's why he's such a successful trader, okay? It's the ones that get lured away, that get excited, that change it up all the times, that shift the rules when they're not finding opportunity. It's those ones that don't find the consistency. And take it from someone that's a little bit more experienced than you. I'm one of those people, okay? I'm one of those that has got a lot of ideas. I'm one of those that so easily gets distracted by new, sexy, different types of strategies. That is the reason why you'll see I created the cue cards. I created cue cards so that I don't get distracted. Because guess what? If it's not on a cue card, I don't trade it. Right? So I found a way to mitigate that weakness of mine by creating cue cards. And hopefully, by the end of this course, you'll come to that recognition. That's the entire purpose of this course, is to allow you to recognize what you're good at, allow you to recognize what you're weak at, build tools for what you're weak at, and maximize what you're good at. And that's ultimately what I'm trying to get across in a nutshell with this entire course. Okay, anyways, we've gone on a little bit too long there. So let's move into it now. You're going to see we've got the 6 different structures, okay? 4, 5, and 6. Five different markets. And I'm just going to remove my face so that we can get some more space here. But in essence, we've got the 5 different markets, and I'm going to take you through all 5 of them and show you the different structures. Okay, so you're going to have lots of opportunity to learn these structures. Don't forget, these structures are also available for you on the course platform. So you can go get them and have a look at these daily structures. Right? Now notice, first one, we've got the CL. Okay, so market is in the bottom left, CL, and it's a daily chart. We're starting from June. Okay, so it's the last 6 months of 2020. So I'm going to go through the structures one by one, and notice in this example we've got 7 structural opportunities. Okay, and these are structural opportunities based on my rules that I adopt. Now, the first one, we have a series of higher low, higher high, trend line is irrelevant, visual cue. Okay, in other words, what we've got here is a series of 1, 2, 3, 4, 5, 6, 7. So we got a series of 1, 2, 3, 4, 5, 6, and we call this a trend channel. Okay, now remember what we said. It's not about where the price trades, but it closes. Okay, so long as we don't close below previous low, that trend channel is intact. And this is one of the big mistakes I see with a lot of young traders. They'll draw the trend line, and all of a sudden this daily low will be broken, and they will assume that it's a bear market. And the next thing, the market turns back around. Okay, learn this with trend channels. They take a lot longer to end than most people think. So we've got a beautiful little trend structure, just a channel structure. Now, the next is we can start to see overhead resistance forming. Right? Notice this candle here, and I'm just going to switch up the color, and I'll make sure this doesn't get too messy. So what we can see here is one form of resistance. Notice the rejection, really swift rejection, market incapable of taking that out. Okay, again, another very strong selling day, nice doji day, right? And again, probably potentially a third very strong selling day. So 3 times the market has tried to get up there and it's formed this resistance zone. Okay, so this would be deemed